Hi guys, good morning and welcome to Power Breakfast in the Mumbai News Centre. I'm Pavitra Parekh and with me is Nigel D'Souza. Nigel, we had a news-heavy evening yesterday. A lot of CNBC news breaks also getting confirmed there. So whether it's the talk of the cabinet nod about bringing stake in the central, in the CPSEs below 51%, the strategic divestment of BPCL. So all of that would be interesting to watch how the markets fare today. Telecom should be the other talking point.
Yeah, absolutely, Pavitra. Very good morning to you as well. I think, the global piece is not looking very, very good. But as you said, a lot of positives coming in on the domestic piece. So interesting times. And today, as always, it's a Thursday. So it's a nifty weekly expiry. So things are likely to move around, particularly in the second half of trade. Well, we'll talk about that and more. First up, let's run you through all the top stories early this morning. Wall Street ends lower while Asian markets start in the red after reports suggest that the anticipated Phase 1 trade deal between the United States and China may not be inked by the end of 2019.
CNBC Newsbreak confirmed the cabinet gives a nod to bring stake below 51% in select CPSEs. Also gives an in-principle approval for the strategic divestment of BPCL, Shipping Corp, Concor, THDC and NIPCO along with the transfer of management control. Finance Minister clarifies that BPCL's stake in Numaligarh refinery will be sold to another oil PSU while NTPC will acquire THDC and NIPCO.
And the cabinet provides much-needed relief to the telecom sector, approves a 2-year moratorium on spectrum auction installment dues for the years 2020-21 and 2021-22.
And another CNBC-TV18 Newsbreak confirmed the RBI supersedes the Diwan Housing Finance Board. Sources say that the central bank may move the NCLT within a week to seek the DHFL resolution under IBC. While SL Group decides to sell 16.5% stake in Z Entertainment to financial investors after the transaction, the group stake in Z will fall to around 5%.
And market regulator SEBI says that listed entities must disclose information to the exchanges within 24 hours if there is a 30-day delay in repayment of loans to banks. The move is aimed at controlling the creation of bad loans. Well, Asian markets, they are low early this morning amid concerns that the Phase 1 US-China trade deal may not be signed in 2019. And on the back of that, a lot of indices are down, anything between 0.8% to around 1.5% odd. The Nikkei is under some pressure. The Kospi as well was down nearly 1% or thereabouts. And even the Taiwanese and Straits, well, they had started off deep in the red and in fact continue to trade in the red. What does all this mean for the SGX Nifty? Well, for starters, the SGX Nifty is indicating maybe we'll have around a 15-point downtick. You need to compare it with the Nifty futures. So in that sense, we should be bracing ourselves for a downtick of around 25 to around 30 points or thereabouts.
All right, let's also take a look at the U.S. markets now. Wall Street ends lower on reports that Phase 1 of the trade deal may not be completed this year. Now, the Dow tanks over 100 points. The Nasdaq and S&P also ended with some cuts. Now, the market slipped from the highs as trade concerns keep investors quite cautious. Remember, yesterday, the U.S. President Donald Trump had threatened to hike tariffs against China if China does not agree to a trade deal with the U.S. We now have CNBC's Eric Chemi to get us a wrap of all of the action that transpired on Wall Street.
U.S. stocks falling on a Reuters report that Phase 1 of a trade deal with China may not be completed this year. The Dow dropping 113 points, the S&P off by 11, and the Nasdaq slipping 44. The Federal Reserve sees little need for further interest rate cuts. That's according to minutes released from its last meeting, where it cut interest rates for a third time this year. Discussions at the meeting indicating that the economy is in a fairly strong place and that concerns over global growth weakness and trade uncertainty seem to have, quote, eased somewhat. General Motors filing a lawsuit against Fiat Chrysler and its former executives, accusing the rival automaker of bribing United Auto Workers officials to receive more favorable terms in labor negotiations. Fiat Chrysler calling the lawsuit meritless and vowing to vigorously defend it. And shares of Target and Lowe's both spiking today after the companies reported earnings that were better than expected. Target seeing strong sales in its apparel category, with CEO Brian Cornell telling CNBC that the retailer is picking up market share from both department stores and specialty competitors. That stock finished the day nearly 15% higher. That's the action from the U.S. market. Back to you in Mumbai.
Well, on that note, let's listen in to what experts have to say about the uncertainty around the US-China trade talks and the Fed's rate hike trajectory.
We're up and down around a baseline that says truce, not resolution, truce.
Right.
Longer term, I think that we are somewhere between a pause button on globalization and a reverse button on globalization. And let me tell you why. It's not just about economics. It's about economics, it's about national security, and it's now about human rights. So over the longer term, I think there's a genuine question about, are markets wired for deglobalization? Over the shorter term, I completely agree. We're going to have ups and downs, and we're going to have a truce that doesn't address any of the fundamental issues. And that's really important, but we're going to have a truce.
In terms of what they did, certainly it puts more cushion for markets. I think that actually helped. The 3 rate cuts actually helped in terms of in terms of the housing market. We were a bit concerned about housing. That looks like it's gotten some more cushion. So you're seeing, for example, building permits go back into more of a kind of a positive territory. That's actually strength for the U.S. economy going forward. I don't know if it really helped in terms of household balance sheets, because household balance sheets are in great shape right now. I see that the impact from this Fed certainly calmed markets. Now that we have a yield curve that's back in positive territory, people are happier on markets. That's a positive. But I don't necessarily see the move in terms of the Fed action gave a whole lot. It gave a little bit, really calmed confidence, but that's about it.
All right, that was all of the opinion as far as the road ahead for the U.S. market goes. But the Federal Reserve has released minutes from its last meeting where they said that the rate cut policy will be well calibrated. Now, following the meeting, Fed Chair Jerome Powell indicated that the Fed was effectively on hold with interest rates, and he said that they would only change if there was some material change in the U.S. economic outlook. We now have CNBC's Steve Leisman to report.
Fed officials at the October meeting after their quarter-point rate cut believe that policy would be, quote, well calibrated. That would be to deliver moderate growth, strong labor markets, and inflation near the 2% target. The stance of monetary policy was seen as, quote, likely to remain appropriate after that cut as long as the economy and the economic data came in line with Fed forecasts. Those 2 bullet points really mean the Fed was thinking it would be on hold for at least some period of time after that quarter-point cut. There were some divisions, though, inside the Fed on this issue. A couple of the participants wanted to state that no cut was coming afterwards. In other words, they wanted to be very explicit about the future path. A couple called the rate cut, quote, a close call. And 2 who we know, Rosengren and George, don't know if it was the other couple we talked about earlier, they didn't want to cut at all. The Fed said the cut was due to the trade war, global developments, economic weakness, and to take out what it said, quote, was insurance against potential downside risks. There were concerns, even though recession chance had faded, there was some improvement in Brexit and in trade at the time, there were still concerns that the weakness in manufacturing and in exports would spill into the labor markets and consumer spending. Kind of gives you a clue that what the Fed is really concerned about. They're okay with it, not okay with it, but they're not all that concerned with weakness in manufacturing and exports if it doesn't spill into the labor markets. And they thought that would threaten the economic expansion and further dampen investment and exports. So several said the rate cut would better align, by the way, the funds rate with the neutral rate and with the yield curve. There were some financial stability concerns mentioned in the meeting. High levels of corporate debt were mentioned and elevated values for risky assets. No additional detail on what those risky assets might be. And they discussed what options. There was a staff presentation about what they might do in the next crisis. That included adjusting their balance sheet with additional quantitative easing, different forms of forward guidance, and potentially interest rate caps. Nothing was decided in any of those regards. Of course, the staff also presented plans on how to solve the repo market problem, including a discussion, again, no decision made, on a standing repo facility.
Well, moving on, trade uncertainty continues to weigh on the economic growth. Fed Reserve Governor Bernard sees the U.S. economic growth moderating going ahead. In a conversation with CNBC's Steve Leisman, she also adds that December tariffs would be negative for the Fed outlook going ahead. Here's an excerpt.
I would say over the course of the last year, trade uncertainty has been a major theme. And we see it in the decline in business investment, we see it on exports, and we see it in the manufacturing sector. So trade uncertainty has been a major factor weighing on the economy for the past year.
Did you factor in the idea that perhaps there would be some easing of trade this year and that tariffs would not go up?
So it's certainly the case that as I've thought about my outlook, prominent among the downside risks to that outlook has been trade conflict. And we've taken out some insurance against that, but we still hear from our business contacts that they're sitting on the sideline waiting for some of this uncertainty to be resolved. I don't think the expectation is for a major deal, but even a truce would be a significant reduction in uncertainty for a lot of businesses around the country that are sitting on the sidelines in terms of investment.
And how would it change your outlook if there were additional tariffs in December?
Well, certainly that would be a negative factor. That would be a realization of some of that downside risk that we've been seeing. But some of the research that we see suggests that just uncertainty alone can be a factor reducing business confidence and reducing business investment. We think we've seen that in the data.
If you put it all together, the New York Fed's nowcast, the Atlanta Fed's GDP now, they're both at 0.4% for the current quarter. Is that where you are in terms of thinking about the economic growth right now?
The U.S. consumer has proven enormously resilient. If you look at retail sales, if you look at consumer sentiment, the U.S. consumer continues to feel good about the job market, and the job market continues to be strong. Most of the businesses that we talk to that are consumer-facing continue to be quite upbeat.
Can you tell us where you are for this quarter and your outlook, say, for the next year?
Yeah, so I can't give you my precise forecast, but I will say that we have seen a bit of slowing, which I would expect. We also saw some special factors weighing on the manufacturing sector that we will begin to see turn around in the first quarter of next year. So we'll see some bounce back from those special factors there. But certainly if I look out over the next year, I see the economy growing slightly above trend. I see continued tightening in a, very strong labor market. And I see inflation continuing to move up to and hopefully a little bit above 2%.
Well, Europe ends in the red territory as Donald Trump's comments on hiking tariffs further kept a lid on gains. In fact, the FTSE was down nearly around 0.8%. Additionally, the European Central Bank, that's the ECB, warned in its financial stability review yesterday that excessive financial risk-taking and a slowdown in bank profitability pose substantial challenges to the Eurozone economy.
Okay, let's also take a look at the currency space now. The dollar comes off the highs from levels of the previous session on reports that the US may not go through phase one of the deal with China. Investors also reacted to the Federal Reserve's October policy meeting closed for the path of future US interest rates.
Well, in the world of commodities, crude oil prices gained closer around 3% overnight after data showed a smaller than expected build in US inventories. The up move in oil prices also came as tensions in the West Asia rose, with Yemen's rebels claimed that they had intercepted a Saudi warplane.
All right, let's get into a short break now, but you don't go anywhere. We'll get you all of the cues and news that you need to know for trade this morning.